are set. Well, good evening, everyone. Welcome to Unit 4. And with a little bit of luck, we'll go ahead and get started. Okay. A quick review of last week of Unit 3. One of the main commandments or things you really need to know in business is you've got to know your customer. You've got to know how they think. You've got to know what they want. Notice I said what they want, not what they need. Okay? So that's the critical element. So the more you can know about your customers, the more successful you will be. Okay? We looked at demographics and how various bits of information are available about your market, the target market that you're working with. And we got to do a little research to figure out how to gather some of that information. We also looked at some additional demographic information. In this case, this slide deals with lifestyles. And here we're talking about, education. We're talking about, home ownership. We're talking about, a variety of things. So there's many, many ways that you can divide up information about your potential customers. We looked at the psychographic description. I think some of the students actually were able to go out and do the survey, and I hope you found that interesting. But it just gives us another way of evaluating that group of people that we're targeting for our customers. And we looked at what kinds of factors will influence a person in their buying decisions. And we looked at the two extremes. There's a continuum, so there are many places in the middle. But we looked at the extremes of emotion or logic. And always the purchase decision is somewhere in the middle. Okay? So we got to look at the details of that. And then we talked a little bit about knowing the trend of our marketplace. Is the target group that we're working with, is it getting bigger or is it getting smaller? That's going to have a major impact on how you plan your business. Okay. From there, we looked at how to segment the market. In other words, how to find a smaller niche within that bigger market and target them with comments and marketing strategies that specifically aim at things that are of interest to that niche group. We looked at the kinds of barriers to entry and how that can either help or hinder your business, mainly in terms of if there's very low barriers to entry and it's very easy to get into the business, then there can be lots of new competitors in the business place. If, on the other hand, it's difficult to get into the business, there are many barriers to entry. You may find it difficult to get in, but once you're in, your other potential competitors will find it difficult to get in. So, it just depends on what side of that fence you want to be on. But you need to be aware of what the barriers are, regardless of the kind of business. Because there's always some barriers. Some are a lot lower than others, but there's always some. Okay. We talked a little bit more about our customers and understanding what they think of us, how we can get across the ideas that we're concerned with. Are they worried about features? Well, then we need to emphasize the features in our product. If they're worried about price, then we need to emphasize price, and so on and so forth. Okay. Then we took a look at the internal, how your business is organized and what are the advantages you have. What are your strong suits both in finances, in marketing, if you're into manufacturing, how you're going to manufacture the items, the variety of things that you have some control over, and how you can evaluate that and emphasize your best strengths. Okay. Then we talked, and we practically ran out of time last week, but we did talk a little bit about your brand and what the idea behind the brand is. is to have an image that when the customer sees that logo, hears that name, sees that the way the name is spelled that unique way, that they immediately have a recognition of what is special about your organization. And so we found that these 6 areas were of concern. What is the strategy? Is your customer, when they recognize your logo, are they going to understand your strategy in the business? Are they going to understand your values? Are they going to understand how you relate to your customers? Are they going to understand the details of your product, what it says content here? Are they going to be able to notice your packaging? And is your packaging, if you're selling a product, is it consistent with the image you're trying to present? And then what tactics are you using to contact your customers and to ensure that they understand that you are fulfilling a want that they have? Okay. Then we also looked at risk management, because every business has risks, as we've talked about. And so the key there was to be able to identify whatever the risks are, figure out what your strong suits are, figure out how you're going to deal with that risk, actually implement your procedures, and then constantly review those procedures to make sure that they are still addressing the risk as you expected it, and that you're evaluating any potential new risks. Okay. So, obviously, if you have any questions, you know how to get a hold of me. Please do. I'm more than happy to talk to you about it. What we want to do tonight is talk about something near and dear to everybody's heart. We're going to talk about money and how we manage our money, and how finances affect a business. So, moving forward, the first thing we need to do is be able to measure how money is flowing in our company. And we're going to start off talking about an income statement. Now, I imagine that many of you have already had an accounting class, and so this is probably old hat to you. But again, it's basic accounting 101, if you will, or even less than that. So we're going to start off with an income statement. An income statement takes a look at the money coming in from sales. Okay? Now remember that part. So whatever you sell, you take in a certain amount of money. We call that revenue, or in this case, sales receipts. And we know that there's a couple things we have to pay. If we have commissioned salespeople, then we have to pay those commissions out. So we'll subtract that from our gross sales, okay? And we'll end up with net sales, okay? And then from there, the next thing we want to do from that total amount of money that we've taken in whatever the period is, if we're dealing a month or a week, whichever, okay? Then we want to figure out what it cost us to get the product to sell. If we manufactured that product, we have all the manufacturing costs. If we buy the product from a wholesaler and then turn around and resell it, then we have the acquisition cost, plus we have the storage costs and anything else related to getting the product to where we can sell it to the customer. Okay? So we call all those things costs of goods sold. Okay? So we take whatever we sold, we had subtracted commissions to get to net sales, and from the net sales we now subtract all the other costs associated with our costs of those goods that we're selling. Now, in addition to those costs, we also have some other expenses of the organization. And these are the administrative expenses, the rent on the building, the paying the staff, all the managers and all the workers and the janitor and everybody else who's not directly involved in the creation of the product. Okay? So all those people come. So we call those general expenses of the organization. And if we subtract that from what was our gross profit, now we have net income before taxes. Now, obviously, the next thing we're going to subtract from net income before taxes is what we've got to withhold from that revenue in order to pay the Internal Revenue Service, the IRS, and any other taxing institutions. So if you have a state tax, state level income tax, you've got to hold some of that money. Okay, so you've got to set aside the money you're going to have to pay for taxes, and that gives us a net profit. But what do we do with that net profit? Well, that's where the money that's left over for the investors, actually you can do a couple things with it. You can use that money to grow the business, or you can use that money as a return on investment that we'll talk about a little bit later, to give some income back to those who invested in your business. Now, that may be you as the main investor, if you start really small, or it may be someone who's loaned money to you, or not loaned it, but actually invested in your adventure. And so the reason they're investing is once you start making a profit, they expect to get a share of that profit. And so that's what we're talking about. So those are the basic steps in creating an income statement. Again, the key there is that that income statement deals with the money that comes from sales. So when you sell something, that generates revenue, then you have these expenses to go against that revenue. Okay. Now, finally, after everything else has been paid off, there ought to be a little bit left over. Okay, so if you've had investors and you've given them some share, let's say that you have investors who own 30% of the company and you own the other 70%, so you pay them a share of the profits, in this case 30% of the profit, and you keep the other 70%. Well, that 70% is your profit for owning this business and operating it. And ideally, every business should have a profit. Otherwise, they're not going to stay in business very long. Now, another financial statement that we want to talk about in basic accounting is what we call cash flow. Now, cash flow is different from an income statement. You have to think of the cash flow as almost like a checkbook, because what you measure is money coming in from all sources, not just from sales. What are we talking about? Well, it's possible, obviously, sales is one source of revenue to the company, but you may have borrowed money and the bank has dispersed that loan payment, that loan to you. Now you have that money in cash, okay? So that goes into your firm. You may have an angel investor who's giving you some money to help get you started. Or you may have gotten so far that your business is such that you can go to a, some other investor, venture capitalist, or a more professional investor, and you'll be getting money from them perhaps. So here in this pile of money, we are not just measuring what we sold, but we're measuring all possible money that came into the firm. So, how do we measure what goes out? Because that's what cash flow is all about. It's what goes in and then what goes out. Well, the things that go out are obviously all the expenses you have. But if you have a loan outstanding, periodically you've got to make loan payments. Maybe they're monthly, maybe they're on a different period of time. So that part of that money that came in has to go out. Taxes. We said earlier we were setting money aside for income tax. Well, every 3 months you have to pay your estimated income tax. So a check has to be sent to the IRS then. Okay. Dividends. If that dividends are those payments to the investors, we call them dividends when we make payments to them. And then owner's draw. That's basically money that you're taking out separate from any payments that you're making for employees. So that's basically your living money that you're taking out of the business. Now, so you see that the cash flow is simply a matter of measuring everything going in, all the money going in, regardless of where it comes from, and all the money going out, regardless of where it's going to. Okay? Now, the problem with cash flow is that sometimes you may have a lot of cash coming in, and you may be tempted to say, gee, I've got a lot of money. I can spend money now. Okay? But there may be another period of time where you have very little money coming in, but now you have a lot of money going out. And so you can very quickly drain that bucket, if you will, of money, that pile of money that's available to you. And that's going to make you a little sad when there's too little coming in and too much going out. Okay, so you have to be careful and plan the use of your money. Okay, another statement that's equally important is what we call a balance sheet. Balance sheet's a little different animal. Obviously, we want it to balance. Think of it as a snapshot, a picture taken in time that says this is the status of my business today. And what we do is we measure really two things. We measure all of the assets that the business has. What's an asset? An asset is anything that you can turn into cash. So you have a building that you own. You have vehicles that you're using for the business. You have inventory of product that you're selling. If something happened tomorrow that you had to shut down the business, you could, reduce the price on the inventory and sell it off very quickly. You could sell the building. You could sell the vehicles. Okay, those are all assets, things you can turn into cash if you need to. Okay? So you measure the total value of all those assets, and we're looking at the real value, not what you paid for them, but what you could get for them if you needed to sell them. Okay? So we measure the assets. Then on the other side of this balance, we want to know, what do we owe? So if you were to shut down the business all at once, you're going to have some bills you have to pay. Well, the money is going to come from the money from those assets. Okay? So therefore, you need to be able to pay off anything you owe out of those assets. And then, ideally, after you've paid off all your liabilities, that there'd be some money left over, and that amount left over is what we call your net worth. So, if you ever look at balance sheets, one of the first things that an analyst will look for is that net worth value, to see how much money is the company worth if they sold off all their assets and paid off all their liabilities. How much would be left over for the owners of the business? That's net worth. Okay, so what are some examples of assets? Well, we break assets down into three categories, but really two main ones. One is current assets. That's things that can be turned in, either is cash right now or could be cash very, very quickly. Then we have another group called fixed assets. Those are things that you could turn into cash, but it's a lot harder to do. It's going to take a lot longer to sell those things, get them, arranged in a way that you could get, sell them and then get the cash out of them. Okay? And then we have what we call other assets. And again, it's going to depend on the business what those other assets would be. Now, if you look at the current assets, obviously the cash in your bank account is part of your current assets. Now, a new term that's here is what we call accounts receivable. And in many businesses, when you sell something, you may not get paid for it immediately. Okay? You may be paid within 30 days, especially if you're selling to a business. The day you deliver whatever the product is to the business, you don't often get a check from them that day. Instead, you give them a bill and then they send you a check, and normally they'll send it within 30 days. And most terms are, net 30 days. 2%, in other words, if you pay within the period of time, in other words, someone owes you money. Let's say they owe you $100, and you bill them on what's called 210 net 30. Basically what it means, if they owe you $100, if they will pay it within 210 net 30, if they'll pay within 10 days, you'll give them a 2% discount. So instead of having to pay you $100, they'd only have to pay you $98. then they have 30 days to pay the rest, okay, or to pay the full amount. Now, if they don't pay within that 10 days, they don't get a discount, but they must pay you within 30 days. All that is accounts receivable. Okay? So, obviously, if you have sold a bunch of stuff and there are customers who owe you money that they're to pay you within the next 30 days, that's part of current assets because you're going to have that money very soon. Inventory, very similar. If you're selling a bunch of product and you have some yet to be sold, well, that's something you can sell. So you can get the cash out of it very easily. And then we always have an other category. Okay? The fixed assets, again, you can see what that is. Those are things that are much harder to turn into cash. If you own a building, well, it's hard to turn that into cash. Any equipment, computers, things like that you have, yeah, you can sell used computers, get a little bit of money for them. You have used vehicles, your vehicles that you can now sell as used vehicles if you need to liquidate everything immediately. But it's a little harder to do. It's not near as quick as the cash or accounts receivable or selling inventory. So all those things are assets. On the liability side, we again have a similar thing. We have current liabilities. Those are things, bills that you must pay almost immediately. Okay? Short term, normally within 6 months. We normally think of current liabilities as within 6 months. Long-term liabilities normally go out longer than a year. Okay? So, good example, if you, let's say that you had what we call a short-term loan from a bank, you go and you borrow, several $100s to make payroll. Okay? You're a little short on cash, you need to make payroll, but you know you're going to have a lot of sales the following week. Okay? So, you make a deal with a bank that you're borrowing the money over for a 3-week period of time. Okay? So they're paying you the money now for you to disperse as you need. You're going to pay them back within 3 weeks. Okay? That's a short-term loan or short-term notes payable. Your income taxes are due every 3 months. So normally that's a current liability. Now some corporations pay their estimated tax every month. It just depends on how you're set up. But for sure, you have to do estimated taxes every 3 months at a minimum. Everybody does that if they're not on a W-2 form. Okay, and then we have other current liabilities. Long-term liabilities, just like we were talking about fixed assets earlier, these are loans that are much longer period of time. An example, let's say you bought a building and you have a 30-year mortgage on it, okay? Like a house. Well, that doesn't have to be paid off immediately, but it's gonna, it's gonna run over 30 years, so that we call a long-term liability. But if you were liquidating the business, you'd have to liquidate that loan too, so you'd have to pay it off. So, and then any other long-term liabilities. Then we get down to net worth, and like I said, net worth is ideally the money that's left over. Okay, and again, that's going to be, when you started the business, you invested a certain amount. Let's say you put $10,000 in to start your business, okay? And now you're a few months into this, and out of that $10,000, there's still $6,000 of it in the bank, okay? Well, yes, that's counting as part of your cash flow, but in terms of your net worth, that's part of the capital that you had paid in. So that's that first item. And then retained earnings, if we go back to that income statement, and we said after we paid everything else off, and we paid our income taxes, and we paid some money to our investors, that we had a little bit of profit left over, well, you can do one of two things with that profit that's left over. You can repay the owners of the business, or you can leave it in the business to grow the business. We call that retained earnings. Okay, or you can do some combination of the two. So you might say, well, I'm going to take out a certain amount each year for a salary. I'm only going to take out $20,000. That's going to be my salary for the year because I really want to get this business going. So I'm just taking out the bare minimum of what I need. And we get to the end of the year, and we find out that there's $100,000 left over. Okay, well, that would be wonderful. That 100,000, well, we had taken 20 of it to live on. That was our draw, our owner draw. And then we turn around, the rest of that other 80,000 can either be retained earnings to grow the business, or it can be paid out to the owners, okay, as dividends. So you can go either way with it, but net worth is how much money is left over after you've covered your liabilities if you had to sell everything off tomorrow. So again, it's a snapshot. Now, in dealing with financial statements, even though you don't, let's say you're just at the stage where you're looking at starting a business and you need to be thinking about these forms, okay, especially these three things we just talked about: your balance sheet, your income statement, your cash flow statements, because any potential investor is going to want to know what you project for those numbers to be over a given period of time. Now, in projecting your financial statements, your income statement, your cash flow statement, your balance sheet, let me see a minute. Okay, so what we're talking about here is projecting our financial statements, because any potential investor is going to want to know what kind of numbers we expect. So, moving forward, there's two ways you can project your financial statements. You can start off with the number of sales you think you're going to have. From that, it's easy enough to predict what costs you're going to have in order to generate that number of sales. And you can tell, an estimate of what your taxes would be and everything else would be, what all the expenses are in order to generate that level of sales. And ultimately, you can then project how much profit you think you will have. So that's one way of going about this. Another way is to start off with the amount of profit that you are expecting, come back and figure out how much it's going to cost you to generate the number of sales it will take to create that amount of profit. And then it's an easy step to go the last part and say, okay, how many sales am I going to need? Okay. Now, both of these are projections. One is starting off with the sales you reasonably think you can achieve, the dark blue side. The light blue side is starting off with the ideal profits you want to achieve and going backwards. Okay? So the problem comes in is what happens if you make this projection. Let's say you start off with profits and you figure out what it's going to cost you to generate that number of profit, and you figure out how many sales it's going to take, and you say, okay, go. And you start your business and you cannot come anywhere near that number of sales because you were too, too optimistic in your projection. It's going to screw up all your financial projections. That's one reason why it's better to start off in a very conservative way. In other words, don't overestimate the number of sales you think you can make. Be realistic. Okay? Look at what other businesses do. Look at what your market is. Understand your customers. Now you can start off with some realistic projections and work your way up. If you can figure out how many sales you can possibly make, it's easy enough to compute what it's going to cost you to make those sales. And then it's a simple matter to figure out how much profit you're going to make. Now the question is, at this point, is that amount of profit that you're going to make going to be sufficient to justify doing the business? Okay? And anybody who's listened to the Shark Tank have seen the potential investors probe questions to the businesses that want to get investors on that particular television show as to how they're going to get to those numbers. How are they going to get enough to generate the right amount of profit? Because that's what it's all about. So that gives you a pretty good idea of how to project. And again, understand they are projections. The people who are going to look at it are going to know they're projections, but they want to know how realistic you're being and how close to raw data that you were able to get in order to generate those projections. Now, a term that I mentioned earlier was return on investment, ROI. Again, if you've had a finance course or a accounting course, you've probably already heard the term ROI, return on investment. Basically, think of it this way. You have a business you want to start. You want someone to invest money in your business, whether it's you or somebody else. Okay? Why would you put money into that business? There's only one reason. Because you expect to get money back out of it at some point in time. You don't always want to just be putting money in. You want to get some back out. Otherwise, why go into business? So, you are going to invest a certain amount of money in that business. Now, each month or each period of time that you're measuring this, you're expecting some kind of profit, and a percent of that profit is going to go to you as the investor, or to any other investors who are putting money into your ideas. Okay, we call that return on investment. Now we convert it to a percent so that we can compare it with the other alternatives that investors have. So for instance, let's say that somebody is putting $100 into your business. Now realize that's a very small number. We can make it 100,000. Matter of fact, let's do that. Let's say it's 100,000, and they could put their money either in your business or they could put it into the bank. And let's say at $100,000, they could get 3% on their money by putting it into the bank. Well, that's safe money. They know for sure they can get 3%. Okay? Now, are they going to invest in your business if you can only promise them 1 or 2%? Well, unless they have some altruistic reason for investing in your business, probably not. Okay? Because they can put their money in the bank and make 3. Why would they go with you and only make 1? Okay? You're risky to start off with. But if the possibility is that they can make 7, 8, 9, 10% in your business, oh, now that's a better idea. If they put $100,000 into your business and they're going to make 10% return on their money each year, that means they're going to take away $10,000 each week, not each week, but each year on your money. That means they're getting 10% return on their money. That's a good deal. Okay? So that's what return on investment is all about, is how much of a percent of the money you put in are you going to get out each year? And we measure it on a yearly basis. Now understand, the startup business may not generate profit in the first year. It may take 2 or 3 years for it to really generate profit. Okay? So now the person, the investor, has to figure, well, I've got my money tied up for 2 or 3 years before I get any return on investment. I better have a lot bigger return on investment 3 years down the road. Okay? And if you ever want to explore that idea, just study what future value of money is all about. But that's a different topic. We'll save that for another day. Okay, so we know what return on investment is. So here's this investor, just as I was talking about, our angel investor. They have a certain amount of money. They can invest it with you. What's your return on investment going to be? They have other businesses that would love to have them invest in their business. And again, how does your return on investment compare with theirs? They could put their money in the stock market. Well, if you look at long-term returns in the stock market, you'll find that they average somewhere in excess of 7%. Well, that's pretty decent return if you're only able to promise 1 or 2%. And then bank, now current bank interest rate, if you put money in a straight up savings account, is less than 1/3%. You're down in that neighborhood. But if you were to put $100,000 in the accounts, banks have other ways of letting you invest your money. So hopefully that makes a little bit of sense. Okay. So let me do. Okay, moving on. Okay, let's go back and talk about that business again. Again, I'm going to use the example of the bakery. Any of you who've had me for the microeconomics class, you're probably familiar with this bakery. So if we talk about what costs that there might be, uh, we know that there's some fixed costs, which is well, we know we have rent, licenses, those kinds of things on the left. On the other side, we have things more related, or costs more related to actually making the product that we're going to sell. Okay? So, the cost on the left, the rent for the building, the license, these basic things, we have to pay those regardless of how much we produce. Okay? So we call those fixed costs. The costs on the right, though, they change based on how much we produce. So if let's say we're just measuring pies, if we produce more and more and more pies, we have to pay the baker for more hours because the baker can only do so much in an hour. The more we sell, the more we're going to have the salesperson's going to get paid because they're going to have to work longer hours to pay it. The more ingredients we're going to have to buy. Okay? And all these other things that are directly related to the volume. So we call those, and again, those costs change based on how much we produce, and we call them variable costs. So again, you have to understand what your costs are and how they relate. Okay? So the question, once you've gotten the business, let's say you start off at a certain level, okay, and you're able to produce at this level, you've got a certain amount of room in the building, you've got a certain number of ovens that you can bake in at the same time, one freezer, whatever. Okay. Now, what happens as you grow the business? Okay. So over time, you're expecting your sales to increase. They will increase at a certain rate, and you'll begin using that capacity up to the point where you can't squeeze any more in with that amount of capacity that you have. All of a sudden, you're going to need a bigger space. You're going to need more room for ovens in the kitchen area. You're going to need more room. You're going to have more bakers back there. So you're going to have to work more hours. Okay. So all of a sudden, you're producing a lot. Okay. That you have to plan that into your thinking as you're creating your business plan. How will you expand? Because you can't just snap your fingers and say, okay, on week at the end of year one, we're going to completely close all this down and we're going to move to a bigger facility. You need to plan all this. Okay? So you have to know how you're going to expand. And again, when the money is coming in and good times are just rolling, and there's all kinds of cash there, be very, very careful not to take too much of that cash out, because you never know when the bad times will come in. Now, I always say bad times. Remember, sales go in cycles. Okay? A really good example of that, especially in a bakery. We have a little bakery going on. You're selling so much every week. Everything is going along fine. Now you get a god-awful storm. Okay? The blizzard that lasts for 2 weeks. Okay, people are snowed in. The power's out. Nobody can get to anywhere. If they can't walk there, they can't get there. And who's going to come by from you? Well, you may have a few people close by, but how are you going to get the power to bake the things if you can't get any electricity? So there may be bad times, but guess what? The rent's still due. The insurance payments still due, even though there's a bad storm. Okay? So whatever's due, the IRS still wants their payment every 3 months, no matter what. Okay? So got to have the money. Can't use it all when the times are good. Okay. One other thing, since we're talking about investment, the question really becomes, where are we going to get this investment from? In other words, any of you old enough to remember the old ads, where's the beef? Well, here, where's the investment? Where's the money going to come from? Well, there are several places we can get money from. Starting at the top right, we can get it out of our own savings, okay, with a piggy bank. Ideally, and that's how most small businesses start. Most small businesses start with the owners taking the money out of their own savings. Okay? The next one would be borrowing or having investment from family members. The good side of that is your family members know you and trust you. The bad side of that is your family members know you and trust you. And they think when you tell them how things are going to be great and you're going to pay them 10% back on their money, and that's way better than the bank will ever give them, and they give you the money, and then business goes south on you, and you're not able to pay them the 10%, they're really going to be heartbroken. And it can develop into some problems. The person in the middle with the wings, we know what an angel investor is. That's somebody willing to invest in your business. Why? Because they believe in you. Okay? But they still need a certain return on investment. Then we get down to the lower left, and now we're talking about venture capitalists. We're talking about the people like on Shark Tank who have money to invest, but they're going to invest it where they're sure they're going to get a return. Okay? Where the potential is so strong that they feel so good about it, that they're just excited about the product and the market, and they can see how this can really go places. And so that's what they're looking for. But you really have to have your ducks in a row for that. And then the place of last resort is a bank. The problem with a bank, okay, is they want collateral for any loans they give you. They don't invest, they make loans. And you're going to pay that back one way or another. Okay? So you're probably going to have to sign over any other property you have as collateral against those loans. Okay? So that's the story on different types of investment. Okay? And so when you start thinking about where is the money going to come from for your business, you need to be aware of these, 5 choices, and how you would approach each one. Okay, and which one is going to be the one you're going to be most reliable on, or most able to rely on. Okay, obviously if you have any questions, you know how to get a hold of me. You know where I'm at. Okay. What do we have this week? Well, you got 2 chapters to read, 7 and 8. Of course, the standard things. Make sure you're still working on your final project. Okay, even though we don't have anything required each week, make sure you're doing the research and the work on your final project. And make sure you come to me when you have a question. Your discussion thread for this week is going to deal with the Hume Company and their luggage and what they had to do to get a certain amount of investment. Okay, what steps, what risks did they face with growing their company? And so we'll have some fun with that. Again, I've mentioned the Shark Tank shows on television. In the discussion thread, I actually gave you some links to some YouTube videos on Shark Tank episodes so that you can get a feel for what they're dealing with if you haven't already seen that. What is our assignment about this week? Our assignment deals with a company called Tactus and how the people that started that, the couple that started that business, how they got to a stage where they had to grow the business and they faced some hard times, and how they'd go about getting money to do that. And so you'll find that case study very interesting. So, again, I mentioned your final project. We know that the final project, just keep working on it. And with that, you know how to contact me. And I will see you in the discussion threads, and I'll see you in next week's seminar. Thank you all very much for coming.